There exists an economic signal so remarkably consistent, so deeply intertwined with the structure of modern financial systems, and so empirically validated by history that its continued obscurity borders on negligence. Yet despite its extraordinary predictive record, it remains largely absent from mainstream economic discussion, underrepresented in academic curricula, and almost entirely ignored by popular financial media. It's not because it lacks credibility or analytical rigor, but because its message directly challenges narratives of perpetual growth and engineered stability. Since 1950, this single indicator has preceded every major recession in the United States, without exception. Offering early warnings before the downturn of 1970, the oil shock crisis of the 1970s, the severe stagflation and double-dip recession of the early 1980s, the collapse of the dot-com bubble at the turn of the millennium, the global financial crisis of 2008, and the abrupt economic shutdown of 2020. Doing so quietly, systematically, and without reliance on speculation, political forecasting, or hindsight reinterpretation. According to decades of historical synthesis and market analysis conducted by economic historian no other, macroeconomic signal has demonstrated such consistency across multiple monetary regimes, fiscal policies, geopolitical environments, and technological eras, making it not merely an indicator, but a structural reflection of how risk, time, and expectation interact within the global financial system. This indicator is the yield curve, specifically the relationship between short-term and long-term. Treasury interest rates most commonly observed through the spread between the 2-year Treasury yield and the 10-year Treasury yield. A relationship that at first glance appears technical, even obscure, yet upon closer examination reveals itself as one of the most intuitive and powerful expressions of economic expectation ever observed. At its foundation lies a principle so basic that it predates modern economics itself. When capital is lent for a longer period, the lender demands greater compensation because time introduces uncertainty, inflation risk, opportunity cost, and exposure to unpredictable economic conditions. Under normal circumstances, this logic produces an upward-sloping yield curve in which long-term bonds yield more than short-term bonds, reflecting confidence in future growth and stability. However, history demonstrates that when systemic confidence erodes, this relationship reverses and short-term yields rise above long-term yields, creating what is known as an inverted yield curve, a phenomenon that is neither accidental nor driven by emotion, but rather the outcome of deliberate decisions made by institutional investors, whose primary objective is capital preservation. These investors, which include pension funds, insurance companies, sovereign wealth funds, and central banks, operate with vast resources, long-time horizons, and minimal tolerance for error, and when they collectively accept lower returns for long-term safety, they are expressing a shared belief that future economic conditions will be weaker than present ones. The yield curve, therefore, functions as a collective forecast rendered not through opinion or theory, but through capital allocation, representing the aggregated judgment of participants who have historically demonstrated superior accuracy in assessing macroeconomic risk. Across 7 decades of data, sustained yield curve inversions have consistently preceded recessions within a window of approximately 6 to 24 months. Performance record that challenges any assertion that the relationship is coincidental or outdated. Importantly, the yield curve does not predict the cause of recessions, nor does it attempt to identify specific catalysts such as financial scandals, geopolitical events, policy errors, or pandemics. Instead, it identifies vulnerability signaling when the economic system has reached a point where internal imbalances render it susceptible to disruption. This distinction explains why the yield curve has remained effective across radically different economic structures from the post-war industrial boom to the digital and financialized economy of the 21st century, because while surface conditions change, the fundamental relationship between risk, time, and expectation does not. When the yield curve inverts, it reflects tightening credit conditions, declining risk tolerance, and a shift away from speculative expansion toward defensive positioning. Developments that historically precede declines in investment, employment, and consumption, even if such declines are not yet visible in headline economic data. The historical record leaves little room for ambiguity. In every instance where the inversion persisted beyond brief technical distortions, a recession followed, and in each case public optimism remained strong until the downturn became unavoidable, reinforcing the conclusion that the yield curve is not a predictor of fear, but a detector of imbalance. What distinguishes the current economic cycle and elevates the significance of the present yield curve signal is not merely that an inversion occurred once again, but that it did so with an unprecedented depth and duration that places it among the most extreme episodes in modern financial history. As the inversion that began in 2022 persisted for more than 2 full years, becoming the longest sustained inversion since the early 1980s, a period remembered for aggressive monetary tightening, entrenched inflation, and widespread economic distress. Analysis from economic historian emphasizes that, while inversion itself represents the warning phase, the historical transition from warning to contraction typically occurs during the subsequent un-inversion. When short-term interest rates fall relative to long-term rates as central banks respond to deteriorating economic conditions, a sequence that is repeated with remarkable consistency across cycles. In 2000, the yield curve normalized shortly before the recession officially began. In 2007, the curve un-inverted months before the collapse of the financial system. In 1990, the same pattern unfolded, and in each instance, un-inversion marked the point at which economic stress shifted from anticipation to manifestation. As of late 2024, the yield curve that inverted in 2022 has begun to normalize, placing the economy squarely within the historical recession window, not as a distant theoretical possibility, but as an imminent structural risk. What makes this moment particularly concerning is the accumulation of systemic imbalances that coexist with the signal, including record levels of government debt sustained outside of wartime conditions, persistent fiscal deficits that rely on continuous borrowing, and interest obligations that increasingly require additional debt issuance simply to service existing liabilities, creating a feedback loop that limits policy flexibility. At the household level, consumer resilience has eroded as excess savings accumulated during the pandemic period have been fully depleted. Credit card balances have reached historic highs. Delinquency rates have begun to rise. Consumption growth has become increasingly dependent on borrowed funds rather than income expansion, a dynamic that historically precedes demand contraction. Labor markets, often cited as the final pillar of economic strength, are also beginning to show signs of fatigue with declining job openings, slowing hiring activity, and gradual increases in unemployment, indicating that businesses are adjusting expectations in response to tightening conditions. At the same time, financial markets remain elevated, driven by concentrated optimism, technological narratives, and speculative enthusiasm, a familiar pattern in which asset prices remain disconnected from underlying economic fundamentals until the moment of adjustment arrives. Skeptics continue to argue, as they have in every prior cycle, that this time is different, that central bank intervention, global liquidity, or structural changes have neutralized the yield curve's relevance. Yet history shows that these arguments have consistently failed to prevent downturns, not because policymakers lack tools, but because economic cycles are shaped by accumulated imbalances that cannot be indefinitely postponed. The yield curve has earned its credibility not through theoretical elegance, but through empirical evidence accumulated across 74 years of economic history, and dismissing such a record requires greater faith than respecting it. Understanding this signal is not an exercise in pessimism, nor a call for panic, but an invitation to recognize cyclical risk, manage exposure, and prepare for volatility within a system that repeatedly demonstrates its vulnerability to leverage delayed adjustment and structural excess. History suggests that those who suffer most during downturns are not those who lacked intelligence or information, but those who assumed stability was permanent, that warnings would be obvious, and that intervention would arrive before consequences became severe. The yield curve offers no guarantees, only probabilities, yet its probabilities have proven remarkably reliable, and ignoring them has never altered the outcome. The signal has spoken before every recession since 1950. It has spoken again after the deepest and longest inversion in modern history. And while the exact shape of the coming adjustment remains uncertain, the lesson of the past is clear. Preparation does not prevent cycles, but it determines who survives them and who is forced to learn history the hard way.